And that'll do it. The closing bell at the New York Stock Exchange, capping off another week of trading. So the Dow opened in the red, but managed to rebound and end the day relatively flat. Not bad.
Yeah, we'll take it. The S&P was also flat for the day, while the NASDAQ is down by about a 0.5 percentage point. Of course, the big economic story today was the July jobs report. 528,000 jobs were added last month, well beyond expectations. Frances Stacy joins us now. She is the director of portfolio strategy at Optimal Capital. Frances, tell us what was driving the markets today.
Well, definitely the jobs report and initially rates. And you saw some dramatic readjustments in the markets early on in the dollar, in gold, in rates, in treasuries. But, you know, as the day went on, all of these dramatic adjustments kind of ameliorated a little bit and fell back a little bit. The thing that remained elevated were rates, which makes sense now that this jobs report has come out, because, you know, it's so part and parcel of what the Fed is thinking about. I think traders are now pricing in 75 basis points for the September meeting. However, you know, we have another jobs report. We have two CPI numbers that are coming out before they make that decision again. And so we have a lot of economic data yet to come before these rates actually move higher. Notably, the volatility for the equities went down, and markets are still showing, you know, a propensity for the upward trajectory. And I think it's just because this isn't happening for 8 weeks.
Well, Frances, given this strong jobs report, and it really was strong, could the Fed take even maybe more aggressive steps to try and ease inflation?
Well, it could, definitely, and it will be data dependent, as he has said. Now, what's interesting, though, is what we've had since he raised rates the last time is we've had a market pricing in a Fed pivot. So that's basically the bond traders are kind of calling the Fed's bluff on, hey, you're not going to be able to go this far. And digging into some of the research, you know, in the tightening iteration that started in October of 14 and ended sort of mid-19 when they stopped purchasing assets on the balance sheet, they went too far. You had a liquidity issue in the system in September of 19, which reignited quantitative easing or bond purchasing on the balance sheet before COVID, right? So that means that they protect the plumbing in the system. And so a lot of traders, based on how the markets are pricing this in, are actually questioning whether or not the Fed can do what it's saying it's going to do because of the plumbing in the system. And we see that by the fact that, you know, credit spreads really didn't move higher. They actually moved lower when you look at the corporate credit spreads. You know, they didn't move higher with the 9 handle on CPI. They didn't move higher with the latest, you know, rate hike in 75 basis points. And so markets are starting to question the trajectory of the Fed.
Interesting. You know, there's also a lot of questions, not only about how the Fed's going to react and how that's going to potentially impact our economy, but whether or not we could be triggering inflation or stagflation. Do you take this jobs report as a sign that we are safe when it comes to a recession? Obviously, the more advanced definition of recession, not just the 2 quarters of negative growth.
Yes, certainly. So I'm in the camp that this is a big bear market rally, but it's still a bear market rally. And the thing is because I don't think the Fed is going to let off entirely, right? So they're going to continue tightening. Statistically speaking, CNBC came out with 61% of Americans are living paycheck to paycheck. We've also seen the credit card data that those Americans are now putting things on credit cards. And the credit card interest rates go up every time we rate, you know, the Fed raises the Fed funds rate. So you're going to probably have a certain point where a certain percentage of Americans will stop consuming certainly anything additional to food and what's absolutely necessary and energy. And also, they're going to have credit problems, which means the credit markets are going to start getting riskier and riskier. And that's the definition of a hard landing. And that's going to be what stops the Fed in its tracks. Now, inflation, if you look at the mechanics underlying the CPI number, you've got energy has fallen off. Oil did not have a big upward trajectory today, even though it may go higher. It's significantly lower. The food prices, commodities have come down dramatically. Used cars have come down. And so these things all have lags before they show up in the actual CPI print. And so you can sort of project, energy has a 1-month lag. Food has on average a 4-month lag. Owner's equivalent rents are still going up because people can't afford houses because rates have gone up. That has an 18-month lag and participates in CPI. So you can see that inflation has likely peaked in the background, even if CPI remains elevated. And that being said, now growth is going down. And so that is the definition of stagflation, yes.
All right.
Frances, Stacy, thank you so much.